Good morning, everyone. This is the fourth capsule under quick revision for examination. Here we discuss the topic monetary policy. What is monetary policy? Monetary policy, as given by D.C. Rowan, monetary policy is defined as discretionary action undertaken by the authorities designed to influence three things. One point number one is supply of money, then cost of money, you can say rate of interest, third is availability of money. So I will discuss the thing in broader sense because if you understand the meaning of monetary policy, you will understand the entire topic. Monetary policy refers to that policy through which government means how government control the monetary policy with the help of the central bank of the country. We have RBI, Reserve Bank of India, which control the credit with the help of supply of money in terms of issuing the currency notes or something like that, availability of money, existing money available in the hands of the common man, people. Cost of money means the rate of interest. When country want to control the credit, at that time they increase the rates. When they want to liberalize their currency, they reduce the rate of interest. So with the help of rate of interest is the instrument through which they control the you know credit of money of the country. Then here are certain objectives, because without objectives na, you cannot control the economy's monetary policy. So there are certain objectives of the monetary policy. Very first objective of the monetary policy is full employment. What is full employment? Full employment is the main objective, the principal objective of every country, whether there is a BJP government or Congress government or any government. Their main objective is, if they want to win the heart of the people, they have to provide full employment to the people. The full employment, how we achieve this objective? To attain this situation, it is necessary to increase the production and demand. For this particular purpose, government should adopt cheap or liberal money policy. What is that cheap liberal policy? When rate of interest is lower than in the market, so that people get more and more money and they able to spend more and more money. If RBI of the country lower the bank rate, then all the commercial bank also reduce their rate of interest. Okay, when rate of interest reduces the cost of production. As a result, price of the goods falls and the demand as well as production rises. And on the other hand, vice versa. You understand the first point. Point number two is economic growth. This is another very important objective. Economic growth is measured in terms of economic development. Economic development, how we measure? With the help of per capita income. Per capita income, how we measure? When we divide the national income of the country by the number of people in that particular country. So in underdeveloped countries now, income and standard of living of the people are so low. This is associated with low production capacity in these economies. Production capacity is low mainly because of low rate of capital formation. On the other hand, low rate of capital formation, these economies fail to utilize their full natural resources and human resources. So if government adopt monetary policy in such a manner so that they increase the capital formation in the country, all problems will solve. Then here comes the third objective, that is price stability. Price stability means how a country can achieve that objective. It refers to the, because in the country na, prices increases, decreases, fluctuation, up down, sometime inflation, sometime deflation. So basically there are two situations. One is inflation. Two factors mainly for the inflation. One is rise in the demand, another is fall in the production. Inflation means economic inequalities causing poor and rich. Richer can afford the product, but poorer cannot afford the product. So this situation na, government increase the rate of interest so that rich people also save their money in the banks. So when they save the money in the bank na, they have less money with them. Prices we can control. Then we have exchange stability. Stability of foreign exchange, that is exchange rate stability. Matlab, how much I have to spend to purchase dollar, how much I have to spend to purchase dirham, how much I have to spend to purchase Australian dollar or something. So exchange rate refers to number of units of another country's currency that can be obtained in exchange of for 1 unit of your domestic, your own currency, like in our case rupee. There should not be many fluctuations in the foreign exchange rate. Changes in the foreign exchange rate are very much influenced by BOP, balance of payment. If balance of payment is positive, means your exports are more than the import, then automatically that exchange rate fluctuation can be favorable. You know, on the other hand, when BOP is negative, in that case, imports are more than export, so your BOP cannot increased, right? मतलब, cannot be favorable one. Reduction in the economic inequalities. This is the last objective. Economic inequalities means in the society, a country like India, richer are richer and poorer are poorer. Maximum wealth of the country lies in the hands of 1% people of the country, okay, richers, and 99% people have, you know, very less kind of money, and they have, you know, they no doubt there is one more class in between them, that is middle class. They have a income, but they don't have a income like rich people, and they not have income like poor people. Poor people have a situation like they not even fulfill their bread and butter requirement, you know, roti, kapda or makan, all these three problem not sort out. So the main objective of the country is to fulfill the economic inequality, reduce the economic inequalities. The richer become richer and poorer become poorer. Rich class exploit the poor class. That's why monetary policy should be like that. It distribute the health among rich and poor in such a manner so that that balanced imbalance can be sought out. Now we have certain parameters. Again, very important topic. No doubt, sometimes they ask in examination about instrument of monetary policy. The answer will be same. Parameters of monetary policy. The answer will be same. Here come point number one, that is supply of money. Supply of money. How money supply we came in the market, or how we can check that money supply. It refers to the currency issued by the RBI. You know, in your book na, that is mentioned authorities. Authority means bank. Bank means central bank. Central bank means RBI. In order to arrange for appropriate supply of money, the central bank means RBI of the country should adopt flexible method. Flexible method of issuing the notes, because when they issue the note na, they follow some minimum reserve for the same. So people are encouraged to deposit more funds in the bank. We have to motivate them so that supply of money we can easily maintain. Point number two is cost of money. What is cost of money? Cost of money means rate of interest. If country want to adopt cheap monetary policy, then they reduce the rate of interest. If they want go for a strict monetary policy, discretionary policy, in that case they increase the rate of interest. These are basically main 2 points with the help, because rate of interest is the instrument. This is a toy in the hand of RBI. They check the money supply in the country, right? In depression like situation, the rate of interest should be lowered and available of money increased, right? In case of boom, the situation is vice versa. Rate of interest should be increased and availability of money should be reduced, right? Now we have availability of money. This is the third very important point. Availability of money, we can discuss this concept in two ways. One is quantitative credit control measures and qualitative or selective credit control measures. First point is quantitative credit control measures. In this particular point, we have first point, quantitative. Quantitative means what? Those method whereby the RBI control the quantity of credit in the country. Quantity of credit, number, in terms of number. huh? So point number one is bank rate. Bank rate me is very important weapon to control the credit. Bank rate means the minimum rate of interest at which RBI of a country is willing to discount the securities. Which type of securities? First grade securities of other banks, or lent on approved securities. Means rise in the bank rate rises the rate of interest, and when the fall in the bank rate lower the rate of interest, right? Means what? There is always a contraction of credit, fall in the aggregate demand, hence fall in the prices when when the bank rate raised, right? When bank rate raised, there is a contraction of credit and fall in the aggregate demand, and hence the prices falls, and vice versa. Then open market operations. When RBI of the country or government buy or sell the securities from the open market, I'm telling you the point. If the credit is to be contracted in the country, means you want to reduce the supply in the country, the RBI began to sell the securities in the open market. You know, they sell the securities, people purchase it. How they purchase it? They obviously spend the money, they deposit the money in RBI, and then they purchase the thing. The inflation like situation can be controlled, right? On the other hand, when RBI think that uh, there is a deflation like situation, they purchase the security from the market, right? Vice versa, they purchase the security from the market. So when they purchase the security, they distribute the money among the people. With the help of that money, people purchase goods in the market. Deflation like situation we can control. Change in the minimum reserve ratio. What is minimum reserve ratio? All the banks are required to keep some percentage, some amount to of their deposit in as cash reserve with RBI. Every bank should deposit some minimum reserve fund to RBI. If the central bank want to contract the credit, they increase the cash reserve ratio. To understand that minimum reserve ratio, they increase. If they want to contract the credit, they want to reduce money in the market. On the other hand, if they want to liberalize the money in the market, they want to increase the supply in the market, they reduce the cash reserve ratio. So with the help of these instruments, they control the credit quantity, number, amount. Change in the liquidity ratio. Liquidity means every bank must keep, every commercial bank must keep some proportion of their deposit always in cash form. Suppose I have 2 lakh rupees and I deposited all the sum in the bank. Bank will not, uh, take or always in a liquid position, not take 2000 rupees, not always in their hand 2 lakh rupees cash. 20% of my some money, or 15% of my money, or 30%, whichever is decided by RBI. They always try to raises the liquidity ratio, deposit the fund in their bank. Whenever I ask for the money, they always ready to deliver that sum to me. So with the help of that instrument also, central bank or RBI is expand credit, it lowers the liquidity ratio. Here come the qualitative or selective credit control system. Selective, qualitative matlab different. The main aim of qualitative credit control means different forms. Like they not directly impose on all other banks, but with the help with certain banks or with certain percentage, or only for individual banks certain restriction imposed. Point number one is change in the margin requirement of the labor of loan. Here this is not labor but loan. Loan means what? Loan means credit guaranteed for certain specific purposes is controlled. For example, a person pledge goods of rupees 100 or of 100 crore to the bank and get a loan of 80 crore from the bank. In this case, margin requirement is 100 minus 80, 20 crore, right? Suppose if margin requirement raised by the bank from 20 to 40, in that case 100 crore security deposited to bank offer you 60 crore loan, 40 crore is what? The margin money. Matlab when RBI want to control the credit, they increase the margin money for housing loan only. You know, housing for certain sectors, for certain loans. Point number two is rationing of the credit. Credit, the central bank is the lender of the last resort. Everybody understand that central bank means RBI. So they, hence if it so chooses, it introduce rationing of the credit in order to control the credit. Rationing of credit means, rationing of credit can be done in four ways. RBI can reduce the amount of loan to all the banks, or RBI can fix the quota for every bank, or RBI can decide the limit of the credit guaranteed to the industry. Another one, it can decline the loan to any given bank. The third very important selective tool is direct action. Sometimes even RBI take direct action against different banks. Say, for example, RBI does not give any financial instrument to one particular bank, say X bank or Dena bank, or any other bank, because I don't want to mention here the actual bank name, because because sanctity hurt, or the goodwill of the bank affected by that thing, right? So next, very next point after the point parameters. In parameter, basically these are the 2 points. That's all for this particular capsule. Keep practicing. Okay, thank you very much.